Hello and welcome to this video about perpetuity. In this video, we will be discussing what perpetuity is, how it works, and the advantages and disadvantages of investing in perpetuities. Perpetuity is a type of financial instrument that provides a fixed stream of income payments that continue indefinitely without any fixed maturity date. Perpetuities are typically associated with long-term investments such as bonds, preferred stocks, or real estate investments. The concept of perpetuity can be difficult to understand for many investors, as it requires a solid understanding of financial concepts such as the time value of money, present value, and future value. However, investing in perpetuities can offer potential benefits such as a stable income stream, protection against inflation, and portfolio diversification. Throughout this video, we will explore the various aspects of perpetuity, including how it differs from other financial instruments like annuities, how the value of perpetuity is calculated, and the risks and rewards associated with investing in perpetuities. So, if you're interested in learning more about perpetuity and whether it's a suitable investment for you, be sure to watch this entire video to gain a comprehensive understanding of this unique financial instrument. What is perpetuity? A perpetuity is a type of financial instrument that promises to pay a fixed amount of money periodically, indefinitely into the future. It is a type of annuity that has no fixed maturity or expiry date, and continues to make regular payments for as long as it exists. Perpetuities are often used in finance and investing to value stocks, bonds, and other financial assets that offer a perpetual stream of income. The value of a perpetuity is calculated using the present value formula, which takes into account the size and timing of the payments, as well as the interest rate or discount rate used to calculate the present value. The most common example of a perpetuity is a consol bond, which is a type of bond that pays a fixed amount of interest every year, without any maturity date. Consols were first issued by the British government in the 18th century, and were used to fund the country's wars. The value of a perpetuity is calculated using the formula PV equals C/R, where PV is the present value of the perpetuity, C is the fixed payment amount, and R is the discount rate or the required rate of return. For example, if a perpetuity pays $1,000 per year and the discount rate is 5%, the present value of the perpetuity would be $20,000, $1,000/0.05. Perpetuities are often used in finance to calculate the present value of certain assets or investments that generate a constant stream of income over an indefinite period of time. They are also used in academic finance to teach and illustrate concepts such as the time value of money, discounting, and present value. How does perpetuity work? A perpetuity works by promising to make regular payments of a fixed amount of money indefinitely into the future. The payments are made at fixed intervals, such as annually, semi-annually, quarterly, or monthly. To understand how a perpetuity works, consider an example where you invest $1,000 in a perpetuity that promises to pay 5% per year. This means that you will receive $50 in the first year, $50 in the second year, and so on, for as long as the perpetuity exists. The value of a perpetuity can be calculated using the present value formula, which discounts the future payments back to their present value. The formula is present value equals payment amount/discount rate, where payment amount equals the fixed amount of money to be received at each payment interval. Discount rate equals the interest rate used to discount the future payments to their present value. For example, if you wanted to calculate the present value of the perpetuity described above, assuming a discount rate of 4%, the calculation would be present value equals $50/0.04 equals $1,250. This means that the perpetuity is worth $1,250 today, based on the promise of receiving $50 per year indefinitely at a 5% annual rate. It's important to note that perpetuities are rare in practice and often theoretical constructs, as most financial assets have finite lifespans and maturities. However, perpetuities are a useful concept in finance for valuing assets with long-term or indefinite cash flows. Can perpetuity be used as a retirement income option? Perpetuity can be used as a retirement income option, but it is not a common choice for this purpose. This is because the income payments from perpetuities are fixed and do not adjust for inflation, which means that they may lose value over time as the cost of living increases. Additionally, perpetuities may be associated with higher levels of risk compared to other retirement income options, such as annuities, which are specifically designed to provide a steady income stream throughout retirement. However, some investors may choose to include perpetuities as part of a diversified retirement income portfolio, particularly if they have a long-term investment horizon and are willing to accept the associated risks. Perpetuities can provide a stable income stream that is not directly tied to the stock market or interest rates, which may be appealing to some investors. As with any retirement income option, it is important to carefully consider the risks and rewards of investing in perpetuities and to consult with a financial advisor to determine whether this option is suitable for your individual retirement goals and risk tolerance. Comparison between an annuity and perpetuity. An annuity and perpetuity are both financial instruments that involve regular payments of a fixed amount of money over time, but they differ in some key ways. 1. Time frame. An annuity has a fixed term or period during which payments are made, while a perpetuity has no fixed term or expiration date, and payments are made indefinitely. 2. Payments. Both annuities and perpetuities involve regular payments, but the frequency and duration of payments are different. An annuity may pay out monthly, quarterly, annually, or at some other frequency for a fixed period, whereas a perpetuity typically pays out at a fixed interval, such as annually or semi-annually, indefinitely. 3. Present value. The value of an annuity is determined based on its present value, which takes into account the size and timing of the payments, as well as the interest rate or discount rate used to calculate the present value. On the other hand, the value of a perpetuity is calculated using a simple formula that divides the payment amount by the discount rate. 4. Use cases. An annuity is often used as a retirement income stream or as a way to pay off a mortgage over a set number of years. A perpetuity is used to value long-term or indefinite cash flows, such as a dividend-paying stock or a bond with no maturity date. In summary, while both annuities and perpetuities involve regular payments over time, the key differences between them are the time frame, payment frequency, method of valuation, and use cases. Difference between annuities and perpetuities. An annuity and a perpetuity are both financial instruments that provide a fixed stream of income over time, but there are several key differences between the two. 1. Time frame. An annuity is a financial contract with a fixed term or period during which payments are made, whereas a perpetuity has no fixed term or expiration date, and payments are made indefinitely. 2. Payment schedule. An annuity typically involves regular payments made at fixed intervals, example, monthly, quarterly, annually, over the term of the contract, whereas a perpetuity typically pays out at a fixed interval, example, annually or semi-annually, indefinitely. 3. Value calculation. The value of an annuity is calculated using the present value of its future cash flows, which takes into account the interest rate or discount rate used to determine the value of money over time. In contrast, the value of a perpetuity is calculated by dividing the annual payment amount by the discount rate. 4. Availability. Annuities are commonly sold by insurance companies, financial institutions, and investment firms, while perpetuities are relatively rare and usually found in specialized financial instruments, such as certain types of government bonds. 5. Purpose. Annuities are often used to provide a steady stream of income in retirement or to pay off a mortgage over a set period of time, while perpetuities are used to value long-term or indefinite cash flows, such as certain types of stocks and bonds. In summary, the main differences between annuities and perpetuities are their time frame, payment schedule, value calculation method, availability, and purpose. Advantages of perpetuity. There are several potential advantages to investing in perpetuities, including stable income stream. Since perpetuities provide a fixed stream of income indefinitely, they can offer a stable and reliable income source over the long term. Potential for long-term growth. Perpetuities may be associated with companies or assets that have a long-term growth trajectory, which could translate into higher dividends or other payments over time. Inflation protection. Perpetuities can offer a measure of protection against inflation, since their fixed payments may rise in value as the general price level of goods and services increases. Portfolio diversification. Perpetuities can help diversify a portfolio of investments, since they are typically not correlated with other assets, such as stocks or bonds. Tax efficiency. Perpetuities may offer tax advantages in certain jurisdictions, as they are typically taxed at a lower rate than other types of income, such as ordinary dividends or interest. It's important to note that while perpetuities can offer potential advantages, they may also come with risks, such as changes in interest rates, credit risk, and other factors that can impact the issuer's ability to make payments over time. Investors should carefully consider the potential risks and rewards before investing in any financial instrument, including perpetuities. Advantage of perpetuity as a retirement income option. One potential advantage of perpetuity as a retirement income option is that it can provide a stable stream of income that continues indefinitely, without a fixed maturity date. This can be appealing to retirees who want to ensure that they have a reliable source of income for the duration of their retirement. Perpetuities can also provide a measure of protection against inflation, as the fixed income payments may rise in value as the general price level of goods and services increases. This can help retirees maintain their purchasing power over time, even as the cost of living increases. Additionally, perpetuities can offer a degree of diversification within a retirement income portfolio, since they are typically not correlated with other assets, such as stocks or bonds. This can help spread the risk of investment losses across multiple assets, potentially reducing the overall risk of the portfolio. However, it is important to note that perpetuities may also come with risks, such as changes in interest rates, credit risk, and other factors that can impact the issuer's ability to make payments over time. Retirees should carefully consider the potential risks and rewards before investing in perpetuities, and should consult with a financial advisor to determine whether this option is suitable for their individual needs and goals. Disadvantages of perpetuity as a retirement income option. There are several potential disadvantages of using perpetuity as a retirement income option, including fixed income payments. While the fixed income payments provided by perpetuities can be attractive, they do not adjust for inflation. This means that the purchasing power of the payments may decline over time, especially if inflation rises significantly. Interest rate risk. Perpetuities are often subject to interest rate risk, which means that changes in interest rates can impact the value of the investment. For example, if interest rates rise, the value of the perpetuity may decrease, as investors demand higher rates of return on their investments. Credit risk. Perpetuities may be subject to credit risk, which is the risk that the issuer of the perpetuity may default on their payments. This risk can be particularly high if the issuer is a small or relatively unknown company. Limited liquidity. Perpetuities are not always easy to sell, as there may be a limited market for them. This means that investors may not be able to sell their perpetuities quickly or easily if they need to access their funds for unexpected expenses. Long-term commitment. Perpetuities are typically long-term investments, with no fixed maturity date. This means that investors must be prepared to hold the investment for a potentially indefinite period of time, which may not be suitable for all retirees. Overall, while perpetuities can offer a reliable and steady stream of income, they may not be suitable for all retirees, particularly those who require flexibility or have a lower tolerance for investment risk. Retirees should carefully consider the potential advantages and disadvantages of investing in perpetuities, and should consult with a financial advisor to determine the most suitable retirement income option for their individual needs and goals. Advantage of perpetuity as a retirement income option. One potential advantage of perpetuity as a retirement income option is that it can provide a stable stream of income that continues indefinitely, without a fixed maturity date. This can be appealing to retirees who want to ensure that they have a reliable source of income for the duration of their retirement. perpetuities can also provide a measure of protection against inflation, as the fixed income payments may rise in value as the general price level of goods and services increases. This can help retirees maintain their purchasing power over time, even as the cost of living increases. Additionally, perpetuities can offer a degree of diversification within a retirement income portfolio, since they are typically not correlated with other assets, such as stocks or bonds. This can help spread the risk of investment losses across multiple assets, potentially reducing the overall risk of the portfolio. However, it is important to note that perpetuities may also come with risks, such as changes in interest rates, credit risk, and other factors that can impact the issuer's ability to make payments over time. Retirees should carefully consider the potential risks and rewards before investing in perpetuities and should consult with a financial advisor to determine whether this option is suitable for their individual needs and goals.